Pensions are, without question, the most tax efficient investment you will ever have. And you put 50 quid a month into your kid's pension from the age of 0. They continue that when they're 18. They're almost a self-made millionaire.
People who are higher net worth get to there by reducing their tax bill. It's not so much always, I've gone out and made so much money. It's how well can I manage that money to sort of not have an impact at the end.
Don't work on the basis of what the government could give you, because we don't know it's going to be there by the time you get there. You've got to look after yourself, because the government aren't going to be able to afford to do it.
Okay, what's one really common mistake that you see a lot of people make?
You know, we could touch on the craziness that is crypto. Because I see that is a major common mistake. Schools don't teach money. They don't teach finance. They don't teach savings. They teach you how to remember stuff.
So we're here on a Trade Legends financial special with a very special guest, Matt Holden-Jones, who is from HJ Wealth Planning.
That's correct.
So, and I thought it'd be really good today, because the one thing that we haven't really touched on here, which I get asked a lot about, apart from social media, I always get asked about how to generate income and also where best to put money once you have generated income into your business. So we have loads of tradesmen and women that listen and watch the podcast, and they're always interested in building their business. And we don't really have too many people that come on that can talk and help them financially as to where to sort of put money. So just give us a little background story as to how you came to be doing what you are today.
Yeah, sure. The assumption in what I do is that I'm really well educated.
Yeah.
And that's probably a poor assumption. So I left school at 15. I was probably kicked out, really. The headmistress decided, when I went in and said, look, I don't want to come to school, she just pulled a letter out the drawer, said, sign that, and that was me done. I was out of school.
It's every kid's dream, that is.
You can't do that now,
yes,
can you?
I'm out!
18 before you can leave. But yeah, so I left at 15. I left home at the same time. Lived on the streets for a bit. Yeah. Lived in hostels in Bristol and Weston-super-Mare. And in terms of jobs, no clue what I wanted to do at that age. It was just a case of work. I knew I had to do something to earn money. So anything from delivering papers as a kid, then to car washing, then, you know, for Vauxhall, I was on their forecourts.
What was the weirdest job you had?
Weirdest job?
Or the one where, you know, if you were to say to somebody, yeah, I did this, they'd be like...
I don't think there's any weird jobs I've done. They've just been like run-of-the-mill. So working in pubs, working in nightclubs. I was a lighting designer for years, so I guess that's probably more on the not necessarily weird, but compared to where I am now in wealth planning to back then.
Do you want a job?
Yeah, with the uni lights, absolutely. So I was on the road a lot. I was touring, doing lighting design for nightclubs. So back where leisure companies used to own nightclubs, being Rank Leisure, Luminar, European Leisure, they owned all the nightclubs throughout the UK, and I used to just travel up and down the UK doing all of that sort of stuff, programming lighting. And then ended up doing what we call white glove jobs. So I'd turn up to events, all the stuff was already rigged up. I just had to go and program it. And then I was doing sort of 15,000 capacity venues, just programming and operating lighting for all the superstar DJs.
Okay. Is that how you got into...
It's exactly how I got into wealth planning.
I was about to say, is that what got you into? Because you do have a keen interest outside of the wealth planning in DJing, making music.
Yeah.
So is that where that sort of came from for you?
I've always had a passion in music. I DJ'd for loads of years. So with the lighting, I DJ'd for Yates's Wine Lodges. I don't know if you remember that.
What's the DJ name?
I got a tattoo on this arm, right? When I was probably younger, actually. I walked into a tattoo shop when I was 15 years old, and sheepishly, and just walked in, just like looking around on all the walls for the tattoos, and went up to this guy, and it was like it's two hearts, there's a dagger going through, and I wanted my DJ name in, which is Flipside. play the flip side of records is what I decided to do.
It's almost as bad as my tattoo, isn't it?
Dear. It is bad. Yeah. It is horrendous, actually. It's the only one I've got. But anyway, walked up to the guy. I said, look, that's the tattoo I want. He said, are you 18? I went, yeah. He went, come on then.
This wasn't one in Digbeth, was it? Because that's where
Bristol.
I was going to say Digbeth. Sorry,
Bristol.
I've just dropped him in it. I was only 15 when I got mine.
Yeah, back then they didn't care so much, did they? But yeah, so Flip Side was my DJ name. And then, I was corporate for Yates's Wine Lodges in Wolverhampton. I forget some of the other places. Southend-on-Sea. That was the roughest place I ever went, Southend. Apologies if anyone listening is in Southend-on-Sea, but oh my God. Yeah. That was an interesting Friday night.
So the DJing and sort of the lighting design, how then did you progress from there into sort of the world of finance and wealth management and stuff like that?
It's called a woman, Al. Yeah.
The sensible head.
Sensible head. So I met Kerry, my wife, who I've been with for 25 years now. Yeah. Funny enough, I was DJing at a bar on Broad Street.
I thought you were going to say Southend. No. Picked a gem up from Southend.
Yeah, no. So she was a barmaid in a place called Cube in Brindley Place. And I won't go into too much detail on here because I think it's probably a bit inappropriate. But met her and we got together. And after about 3 years of us being together, she's like, "You've got to get a proper job," because I was just on tour. Either events happened or they didn't, and then you're reliant on that for income. So she's just like, "You've got to find some stability."
She killed your dream.
She killed it, dead.
Superstar DJ.
So I went, and my first job in any form of financial world was for Lloyd's TSB registrars. So in a call centre, answering the phone to angry shareholders. That was my job. It was mundane. I hated it. I got pulled into HR after 8 months of being there. They pulled me in and said, "Matt, you've been here 8 months." I was like, "Yeah." Said, "You've turned up for 4." I'm like, "Yeah." They went, "Do you want to go?" I was like, "Yeah." And left that same day. Went to my bank manager, and back in the day when I left there, which is going back over 20 years now, and I went to my bank manager. I said, "Look, I've left my job. Can I have an overdraft?" They're like, "Yeah, no worries." They just print money back then. No worries about how I'm going to pay it back. They're just like, "Yeah, have an overdraft." And they just said, "Why don't you come work for us?" So I went for an interview, a local director, 10-minute interview. Walked back out. 10 minutes later, got a phone call from him.
Sounds very Wolf of Wall Street.
It was, because he just went, "Hey, boy, start Monday," and that was the start of my career in banking. I did 11 and a half years in the bank then for Lloyd's, Santander, and Halifax, and that was basically how I got a start into wealth management.
Okay. And do you look back now and think, if you'd have done things differently, the job that you'd be doing now was different, or is it, do you enjoy what you do now from where you were? Is that something that you if somebody's listening to this as well and they're thinking, well, I know a lot of people that are listening to this are going to be trades, but if somebody's in a trade maybe and they're thinking, actually, I wouldn't mind going the opposite way.
I think what I do really is a trade, funny enough, because yes, I do love what I do. I sort of fell into what I love, which is dealing with people, and I suppose the output of what I do, which I guess is somewhat similar to trades. You do a good job, you walk away from it, people are happy, right? And it's sort of similar with wealth management. You get to know people, you do a good job, and they go away happy, and they know more than they did the previous day. And we've helped to secure their family and their future, and they're managing money properly and all that sort of stuff. So it's a real good feel. It's a feel-good job, what I do. Yes, it's hard work. It takes every hour of every day.
Because you get people like me messaging you. "Can you help me with this, please, Matt?"
I don't mind it. It's good, and you know what? That's a big takeaway, and something I've learnt over the years is that saying yes to everything is a really, really bad idea. But there's a good balance to be had. But coming back to what you were saying, do I love it? Yes. Did I ever think this was going to be my role in life? No. I think whether it's common with men, I don't think we've got any clue what we want to do until you're at least like age 30.
Yeah.
And the bit that I found from working at the bank was, because I was only an account manager there, I was earning, I don't know, $9,000 a year was my first job. And it was just interviewing people and trying to sell them bank accounts, savings accounts and insurance. That was it.
But you don't realise actually when you're doing that part of the job that the stuff that you do now is actually giving you the skill to go and talk to all different types of people. So however mundane you think that sort of, I was just selling people standard bank accounts and stuff like that. But actually now when you're talking about financial products, that's probably what's giving you your... It
was a phenomenal grounding. One, because of the hours, because the bank just expects you to work every hour God sends with no overtime, none of this, that and the other. It was hard sales. I know the bank try and sort of I don't take anything away. I think banks have got their place in the world, but from a wealth management and advisory perspective, it's 100% not.
So what would you say if somebody is listening or watching to this and they want to get into something similar, or they're quite interested by what you've said so far? How would you say is the best route into doing what you're doing? Would you say go and work in a bank and learn that side of things first, or would you say go and work for somebody doing sales, regardless of what it is? Or what would you say is the easiest? Well, not the easiest, but probably
a route in.
Yeah.
The banking world's changed massively. So where you would have financial consultants, they're not there at the banks anymore. If they are, it's very, very far and few between. To get into our world now in wealth management, there's a lot of exams, huge amount of exams. So do you need to be academic? Or going back to when I left school with 0 GCSEs, none, to becoming an academic now and almost being chartered at what I do. Don't ever think you're not academic. When you start to do the exams, then you know, either you've got it or you haven't to be able to pass exams, and it's just a memory game, really. You don't learn the job through doing the exams. But to get into it now, it's administration, which sounds a bit rubbish.
Yeah.
There are a lot of wealth management companies out there who will train you. So we've got an academy, not me as my company, but my umbrella company, which is St James's Place Wealth Management, and they run academies for people who've from all walks of life. Could be from the army, could be sports professionals, could be salespeople. We've been in car sales or something like that. I suppose if you're good with people, that's what you need to be good at to do this job. The technical aspect of what we do, you learn by doing the job. So you can pass all the exams known to man to do what I do now, and you still wouldn't know what to do when you're in the real world. It's just through that experience of dealing with people that you'll get to learn the job.
So when somebody now is coming to you as a customer, for example, so what type of things are they asking you to help with?
So if it was a 50-year-old, it's, have I got enough? I don't think I have. I'm worried I've got 10 years to retirement. Yeah. That is common around 50-year-olds. That is definitely a common thing. It's
definitely one thing that's common in trades, men and women anyway.
Yeah. Well, yeah, I'd imagine so. It's, without any financial education, or if you haven't been in the habit of doing things at an early age, you tend to find that catches up with you.
What's one thing that you would say to everybody that's listening, that's young now, to start doing, like literally after listening to this podcast? What's one thing that you would suggest to do?
See money as something that's really serious. It's easy from a young age just to be frivolous, to go and
go and DJ around the country.
I never made money doing that. Oh my god, no! I made zero money. I'll spend it all on beer and accommodation. That was it. Yeah, I never made a penny. It was good life though. It was good fun. But from a young age, what I tend to see, and if I look back at how I was I always sensible with money? No, I earned money.
I don't think anyone is.
I earned money to survive. That's how I was back then. So I didn't ever see anything as a career. But I think the people I'm talking to here, through apprentices who are a bit younger, and then those who've sort of gone on to sort of build their careers in what they do. It's about, how do I put it in the right way? I think with the way social media is these days, and look, we're on social media right now, I think it's very easy to sort of look at what the next person's got and just go and think, I'm going to go and do that. And that's their focus, rather than doing what they do well to earn more money, to basically give them what they need further down the line, perhaps. Everyone wants what they want now. Yeah. And sometimes they lose focus on being able to do it comfortably, and therefore spend what they've got. And then wonder why they can't invest into things, why they've got no savings to fall back on.
So don't be short term.
No, it's all about the long game. When I started this company, I had zero. There was zero in the bank. Kerry was earning 34 grand a year. We had a big mortgage. We had no kids, so that was a bit of a help. But her income could just about cover our bills with zero luxuries, zero. So we started the business then. To try and build a company and build it quickly that we could survive, and then start to do all these things. But rather than spend the money I had, which I think is coming back to what you were asking, I invested the money I had into the company to keep growing it.
Yeah, because one thing I didn't realise until obviously I was speaking with you is something even as simple as being able to do pensions for your kids. So, you sit there and you're looking at all these financial products and you don't realise that actually you can have a pension from
Zero.
pretty much day dot.
Yeah.
So there's little things like that where I've got you on because I just want people to realise that the sooner you sort of get into the routine of saving money, investing money, the sooner you can actually retire. But people put it off, because they don't know, there's a lack of financial education, or people just aren't interested at a certain age. So sort of trying to gauge and grab information out from you as to what would you suggest to somebody then who's 16, they've just left school, apprentices, they're not on a mega wage, but how would you say to financially sort of gear yourself up for those, because you might only have 20 years worth of work. You might knacker yourself as a tradesman or woman, and you've got to get off the tools, or you've got to reinvent yourself. What would you suggest to people?
There's twofold answer to this, because I think from a financial advisory perspective, it's not purely about just investing and saving. The first thing you do, weirdly, is make sure your foundations are set and that you've got some aspect of protection. So protect your income. So coming on to what you said there about if you were ill or seriously ill in an accident or couldn't work for some reason, whatever that might be, it's making sure that you've got some form of insurance, some form of protection to go, if that happens, I can still pay my bills.
Because a lot of tradesmen and women especially, they've got insurance on their tools, on their van, liability insurance, but they don't actually cover themselves if something was to happen to them, to then say cover their mortgage.
So here's an interesting one. So I'm going to ask you, Al, so what is the most valuable asset you have?
Myself.
There you go. That's the answer. And most people, you're a slightly different...
I don't know whether you asked my wife, she'd say definitely not you.
But. It probably wouldn't be, let's be fair. The common answer with people, I guess, who are a bit older is my house. That's my most valuable asset. So then I'll take their house and we say, okay, the house is £500,000, just as an example. Mortgage is 400 grand. So you've got 100 grand's worth of equity. Then if we said, I don't know, they're earning 50 grand a year and they're 20 years old, now multiply your income until your chosen retirement age 60. Now tell me what's the most valuable asset. And you're right, it's you as an individual. So where they cover insurance for their tools and things like that, actually what they really need to be covering as well, in addition to that, to get their foundations set, is covering their income. Making sure their debts are covered. That is important. Once you've done that, then it's about thinking, right, what comfortably out of my income can I save? It doesn't have to be everything so you have a miserable life, because as much as I'm into wealth management and I'm into saving, growing money and getting to a point where you've got enough around you to do all the things you want to do, it's about just doing something rather than nothing. So coming back to the apprentice, 16 years old, it's about going, let's just put something to one side and treat it not like savings or investment, treat it like a bill. That sat with me. Someone said that to me. It's like gas, electric, council tax, savings. Use that mentality that you have to pay that bill every month, every month without fail. So if you can have that, that's your bill. You start with that then starts to build habits. Once you're in the habit and you start to see it grow, you start to see that you've got a pot around you, becomes a bit more comfortable, allows you to do other stuff, invest in yourself or your business or whatever it might be. That's the mindset to have.
Yeah, because I find when you're younger, anything that comes out as a deduction, you see it's like, it's a big thing. And then some people also, when they get a bit older, they forget about these other things because they've got so many other bills as well. So they're thinking, well, I've got to look after the kids now, so I don't want to be putting that away. I need that money for the kids. So I'm sort of, what I'm trying to say and what I'm trying to sort of gauge from you as well is like how to build the good habits that sort of, as you get older, you consistently keep those same things. I mean, if there was, somebody then as an apprentice, what would be the one thing if they were to say to you, where's best to put my money? Is it a pension? Is it just savings account? Or what would you suggest to somebody to, because obviously pension, people go, oh, well, I can't touch that until I retire. But obviously the conversations I've had with you about SAS or SIP, that you can actually take that money that's in your pension and actually utilise it to buy a commercial property. Something that I never knew many years ago. Pensions
are, without question, the most tax efficient investment you will ever have. And I get it in terms of being able to access it from 58. and as a minimum age now, for people who are much younger, 55 as it is now, legislation's changing, it's 58. That's the minimum age that you'll be able to draw your pension. But if you do the right things along the way, the pension is the last thing you will ever take, or ever should take. So if you've built cash around you, you've got ISAs, you've got your unit trusts, your bonds, venture capital trusts, whatever it is you've built up, the pension, when you come to retire, people just think, oh, I've retired now, I'll take my pension. Completely wrong in most cases. So if people have done the right things, they've built a good level of assets around them, pension's the last thing you take. Yeah, we've touched on this personally before. You know, your pension, if you die, is 100% left to your family, completely free of tax, which is great.
It's inheritance tax free as well, isn't it?
Inheritance tax free completely. And you can leave it to next door neighbour, you can leave it to whoever you like. It doesn't have to be family. So even if you don't have a family, you want to leave it to a mate, you can do that. That's absolutely fine. If you die before age 75, whoever inherits the pension, as long as you took no income or capital from the pension, then they can inherit that and they won't pay income tax on any of those withdrawals at all. And then there's some complexities when you get over age 75. But coming back to the importance of pension, yes, it allows you to do things like commercial property investment. Why would you do that?
Well, if you say you've got your own business, you've got a unit, or you want to buy a unit, you can actually potentially buy your own unit and then pay that money back into your...
And the power of it. So if we touch on the power of doing that and why you would do that. So everyone's got a personal allowance annually that you can invest into pensions, which is 60 grand at the moment. So let's just say, cash clock forward, you've built up some good money in your pension, and like you've said, you've got a commercial property that the company owns, or that you're even leasing, and think, I don't want to keep paying this rent, I want the property for myself. Well, as an example, if you were paying, I don't know, let's say 100 grand a year in rent for a building that you're in, that money, if you own it, can be going into your pension completely tax-free. And not only that, it doesn't use your annual pension allowance. So you can have your 60 grand going in, plus the 100 grand from your rent going back in from the building you already own. So then you've got your building growing in value over time, and then you've got the rent going in, which is gone and completely tax-free as well.
The 60 grand on your pension will reduce your...
corporation tax.
Corporation tax.
Yeah, which is major. So anyone who has a business, for sure.
Especially now that's gone up as well, hasn't it?
Yeah. And who knows where it will stay. But, at the moment, it's like, use those allowances wisely.
Ladies and gents, just a quick one to say a huge thank you to our new headline sponsor, CT1, the best sealant on the market, voted for by the British public. Not only that, it's made in Britain as well. So go and support a product and a brand that is made in the UK. But I just want to say to you, they've got a brand new product out, which is the BT1. It's a combination sealant and adhesive like the popular CT1, but it's perfect for keeping a hygienic environment. And it's designed to completely stop the growth of bacteria, microbes, and fungus. And not only that, this stuff is strong. Now, it's going to be available at Travis Perkins, Wickes, Jewson's, and pretty much everywhere else, so there's no excuse not to go and give it a go. So we're really happy to be partnering with CT1.
Going back to the 16-year-old who's thinking, oh, why do I want to pay into a pension? It's appreciated that retirement at 58, if it was going to be that old or young, whichever way you want to look at it, is a long way off. But it's about building those habits. It's about thinking, right, how can I make the most out of the money that I'm earning? Because by virtue of paying money into a pension as a self-employed person, maybe not in a business, well, you're going to reduce your income tax. So the net cost of paying money into your pension isn't what you're physically paying out. Because you'll get 20% for doing nothing. If you're a 40% taxpayer, well, you can claim another 20% back through self-assessment.
Because the one sort of thing I always hear with pensions is, well, you've got to pay the tax when you withdraw the pension, when you draw down and stuff like that. But what I try and say to people is, you can minimise some of these things because it actually gives you time to plan more effectively for when you come to retire. And obviously, yes, you're kicking the can down the road, but theoretically, the level of tax that you will pay down the road is less than if you're not doing that now.
Correct. Yeah. I mean, so basically, use HMRC's money now, get free money, because that's all it is. 20%, 40% relief on your pension, that's without market growth. That is just pure relief. That tax relief is just free money, if you want to look at it that way. just take a company as an example. So if you distribute dividend or PAYE, whichever way you pay yourself, you are going to pay tax on 100% of that money. So this argument around, well, you've got to pay tax at some point in the future. Yeah, you're right. But if you structure your planning in the right way, if you've built up £1 million pension pot by the time you retire, you've got £250,000 worth of tax-free cash that you can take out. Most people think you've got to take income from that pension at that point. And the answer is you don't. Because you can go into flexible drawdown. And if your needs, if it was purely from pension, didn't have an ISA or anything else to rely on, you just needed income from that, you can defer the tax on your pension by just phasing the tax-free cash out bit by bit. So if you said, Matt, I need 50 grand a year, I'd say, all right, I'll take 50 grand out of your pension pot from the tax-free cash element and not pay any tax on that. Now, you'd still use your personal allowance, 12,570 as it is today. You might have that bit of income from your pension, and then the rest of it take as tax-free cash. And then you've got, for ease of numbers, 5 years of paying no tax on that income that you want at that first part. Which is majorly powerful. But coming back to pay yourself the money out of the business now at 100%, or pay yourself out of your pension further down the line and pay tax on 75% of it. It's a no-brainer.
I mean, so the other thing then now is, say, I'm trying to do examples for people because I want people to sort of go, oh, actually, and something twigs for them. So the whole point of this is not getting on to sort of say you should be doing this, but just to, I wouldn't say inspire people, but just sort of twig them so that they go, oh, actually, that's quite a good little thing. Say you're a limited company or a sole trader. You make maybe £100,000 or £150,000 for the year. What would you suggest? Somebody's, I don't know, 30 years old, they've got their own business, and they want to be able to sort of start planning now. They've maybe got one child, looking at having another kid. What sort of stuff would you be saying to them to utilise their money? Obviously, we talked about pensions and putting that away. You've got, say, the husband and wife, they work together on the business. What would you be suggesting to people to sort of plan for the future?
So, I guess starting from the ground up, trying to get ducks in a row, coming back to what I said earlier, make sure your foundations are set. Make sure you've protected your asset. Your asset is you and your income. Make sure you protected your debt if you're carrying debt like a mortgage and stuff like that.
So sort of like an insurance policy.
Make sure all of that's done, life and critical illness cover. I guess this is
and how much roughly, depending on obviously your health and you're not too buggered. What's a typical monthly payment on a 15, 20 quid on a critical illness policy?
So this is where, again, leaving the bank taught me what's right and what's wrong. And I'm going to use some simple stats for the UK. 1 in 4 people will get a critical illness. 1 in 4. But the bank, when you borrow money, try and sell you a life policy. Life policies, if you were to cover yourself, let's say you're age 30, coming into this scenario you're talking about, and let's say, I don't know, you've got £250,000 worth of mortgage. That cover will probably cost you about 10-15 quid a month. And it's cheap. And the reason it's cheap is because it's less likely that it's going to happen. The thing that younger people bulk at is the cost of critical illness. And critical illness policy in comparison might cost you 50 quid a month. But that's the more likely thing to happen. The reason it costs more money is because the insurers know that's more likely to happen. Whether it's cancer, heart attack, stroke, all the core things that you
even if you're in a trade as well and you're a roofer, you could fall off the roof. Do you know what I mean? So I always think that if you have an outstanding debt, is one thing you don't want to do is something happens to you, you can't work, and then you end up losing your house or whatever because you can't cover your bills.
And you've got to weigh it up. Go, well, either if all you had was 50 quid spare a month, would I be saving? No. Would I be putting it into an insurance policy? Yeah, I would. Which sounds really boring, doesn't it? And it is. However, weigh up the cost of not paying that, or let's look at it the other way and go, well, okay, if I was saving 50 quid a month for the year and I did that for 10 years, would that amount of money pay off my mortgage if I couldn't work anymore?
And the
simple answer is no. So, but could an insurance policy pay it off if you took the right amount of cover? Absolutely. So ducks in a row is a key thing. Make sure that grounding's there. And then using your scenario, 100 grand a year, joint business owner, limited company, husband and wife perhaps that are in there. We've touched on it. Pension allowances is key for sure, because getting your corporation tax down and moving money out into your pension, that is that is just the most tax efficient thing a business can ever do, really. Outside of that, you're distributing dividend and PAYE for your lifestyle. And it's thinking about, well, okay, again, if I'm paying out this amount of dividend, paying tax at whatever level you're going to be paying out, if it's 100K, then clearly you're paying it at 40%, or the dividend tax at 38.1. But you've got to think about what you're doing with that money on a monthly basis. So a simple thing to look at is, I think maybe, I don't want to blanket anyone in this industry, but I think in trades, I was in trades, so I've done things like this. I've laboured, I've done all of that stuff on building sites as well. Spend 27 quid a day, buy your lunch, maybe a couple of beers or a coffee, whatever it is you do. You do that every day for 365 days of the year, you've spent 10 grand. Yeah. But if you've got a business or even as a self-employed person, realistically with the tax, you've just blown 15 grand.
Yeah.
Without even thinking about it.
So make your packed lunches, boys and girls.
It's true though, right?
Yeah.
Prepping your meals, all this sort of stuff. I mean, we do it for fitness, right? I suppose I'm fortunate now I don't have to do that. It's just a luxury, really. But actually, from an early age where you're trying to sort of build your wealth and just think sensibly what you're doing with your money.
Well, you look at that money as well, and if you do have kids, that money that you are spending each day, that 20 quid or whatever it costs you for your food, you could be putting into kids' pension.
Yeah, absolutely.
And then basically you know that when the kids get to a certain age and they start working, they're going to have a decent enough pension. So it's stuff like that where you...
So, calculation that I did or was provided to me when I was at the bank was, and you can quote me on this if you like, you put 50 quid a month into your kid's pension from the age of 0.
Yeah.
They continue that when they're 18 until they're 60, what would have been 66 back then. But you compound the interest and the growth on that, even at 5%, they're almost a self-made millionaire.
Not bad, is it?
From 50 quid a month.
Yeah.
And arguably
with
these days,
inflation now, they're going to need to...
Yeah, £1 million not what £1 million used to be, is it? It isn't. You look at the price of property, the way it's gone, it's hard to buy it. And the reason for that is on average, property prices have gone up 4% every single year.
I know how we're talking now. We're going to have a load of people in the comments screaming, going, just put it in real estate, you compound better in real estate, all that sort of stuff. Yeah. So the other thing, especially for tradesmen and women, is if they were to take that money out and put it aside, even into like an interest account to save, within the year or a couple of years, you can have enough money then to go and put down as a deposit on a rental property or on a serviced accommodation and stuff like that. And then that money also becomes another business. Yeah. So these are things that I'm always trying to get across to people is don't think short term. No. You've got to think 5 years down the line or 10 years down the line.
Yeah, and a good bit of advice at that point is if it is building money, say, within a 5-year period, to go and do something like that, to put a deposit down or to buy another house, whatever it might be, the position you're in, is don't use risk-based investments to do that. So this is a good bit of advice. Use cash, but be really, really careful with it. Make sure you've got it in a pot that's out of the way, that you're not tempted to go and buy a holiday or a watch or whatever it is that you want to do. Treat that money like the bill and let that go in and find the highest interest account you can find. Premium bonds is another way.
I feel like that comes from building the habit from 16 or even earlier. Yeah. And then, like you said, treat it as a bill and you put that money away and you never really think about it until you need it. Yeah. And that's why, if you're looking at it all the time, you're going to think, I could go and buy a new car with that, or could go and buy a watch, or I could go and buy a nice holiday and take the kids away.
And it's easily done, especially with the way social media is. You're always comparing yourself to other people. Yeah. It's easy to do, but you've just got to look at what's important to you. Because actually, I think you know this yourself, Al. I've built a mindset now where I don't give a stuff what anyone else thinks about me. I do about my clients for sure, but that's not like an act I put on. That's just me, and I get on with people, and it's a relationship game that I'm in. But it's about doing what's right for you. Focus on you, because actually when you realise that the car you have, the watch you have, the clothes you put on your back, no one gives a stuff.
Yeah. No one actually notices you.
No, it's only what you think.
What's one really common mistake that you see a lot of people make that could easily be rectified, or what's the biggest financial mishap that you see?
Yeah. Something that's really, really common. Self-investing. Okay. Now, there's nothing wrong with that in the sense of putting money away, you know, and investing it wisely and investing it into things that produce income, like shares in a company as an example. But what I see where they get it wrong is either not investing into enough things, so not diversifying. So they might just invest in Tesco or Vodafone or BP, whatever it is. They don't spread things out. They take a high risk approach with it. That is quite common. And then I get a lot of people come to me going, Matt, I've got this portfolio of stuff, and some might have made an absolute stack load, and there's a good load that's either lost money or gone completely.
Because most people I find who invest in stocks and shares tend to lose money, and that's because they pick a business. Oh, Vodafone. Yeah. I've seen them. I use Vodafone.
It's pub chat.
Yeah.
And one of the things we see is that, you know, I come to you, Al, today and go, right, Al, this is the best thing ever. And you go, oh, great, I'll invest in that. But the reason it's the best thing ever is because it's already been the best thing ever.
Yeah.
So it's already had that growth. They've missed it. But then, you know, when you look at managed investments where you've got a portfolio of stuff, we might have in a medium risk portfolio, I don't know, 350 companies in there. So it's hedged, i.e. if sun cream's not doing well, umbrellas will be, you know, dependent on if something's, and that's the way to look at it is that is a mistake just to go into a few things within a portfolio. Buy a fund, buy an index tracker, do something like that. If you want to do it yourself, just don't pick single company stocks. And then, you know, we could touch on the craziness that is crypto, if you want, because I see that is a major common mistake.
So the only thing that really angers me about people that talk about crypto is that's all they've invested in.
Yeah.
And all it takes is for somebody to, you know, hack into a platform, you know, like Binance, look at the stuff with FTX.
Yeah.
And old Sam Bankman-Fried, or whatever his name is. And I always feel like, you know, that obviously I've been posting stuff on my own Instagram, and I find that people will hammer me for talking about boring things like a pension or a lifetime ISA or an ISA. But I'm doing these things as well as doing other things. Yeah. And that's where, obviously, like you're talking about, you're hedging yourself. So if one of them does go to the wall, like crypto, I feel crypto will go to the wall, then you're sort of, you know, all your eggs aren't in one basket.
Yeah. And you can diversify with crypto as well, right? So you've got lots of different types of coins you could have. Yeah. But if I told you I've got in excess of 500 odd clients, some of which have all bought crypto along the way, against my advice, have a guess how many have made money? Give me a percentage.
Maybe one.
None.
Yeah.
None. Simple as that. And all right, it depends on the time of, wherever we are in the year, wherever the values might be. But even if they have made money or profit, have they realised that money and took it out? Because it doesn't produce income.
And the difference is as well now, that's taxable.
Yeah.
So the money that you make, because obviously the government's come down on crypto as well. Yeah. So it's sort of, I think a lot of people will jump on a bandwagon, and I'm sure if you ask probably 90% of the people that have invested in that you know, tell me about Bitcoin, they'll just go,
It's when I ask them the next year, so you bought that, how's it doing? And they don't want to have that chat, and I have to, I'll put the update of wherever their values are on our systems just to see where we're at with things. And never seen a positive story yet. And it's not to say that can't happen, but when you look at crypto as an asset, it doesn't produce income. It's very hard to get it out. Yeah. If at all, we've all seen the stories, we've seen the frauds and the mismanagement of companies and so on.
I mean, the only time something like that is good is if, again, you're very long term on it, and you've brought in low, and you've just left it, and you've done nothing with it.
You've got to treat money like that as beer money, because who knows what will happen with regulation. Yeah, we've seen obviously Tesla bring it in, and then they use it, and then they don't. And it doesn't take much for the big boys who have been doing this for a long time, who have multi-billion-pound funds, to sneeze. Yeah. And all of a sudden, everyone who's put the 50, the 100, exactly. Yeah. And that happens more often than not.
Yeah. So, I mean, I look at stuff like real estate now, and you've got the likes of the big banks now who are going round and buying rental properties. They want to be the biggest landlord in the country. And you sort of, you listen to all the news, people are leaving buy-to-let now, they're getting squeezed. But then somebody else is buying up these buy-to-let. So I always think, you have to judge stuff for yourself, and not old pub Dave, oh yeah, this is, get yourself into this.
Yeah.
And like you say, every scenario is different because of your circumstance, your
Correct.
age, or you've got kids, you don't have kids, and all that sort of stuff.
And the other thing is the pub Dave will tell you what they want to tell you. So they'll tell you all about the positives. What they won't tell you is about all the ups and downs, all the challenges.
They've lost 10 grand last year.
Yeah, exactly. And there will always be ups and downs, but no one will ever tell you about that difficulty or that challenge. They'll only tell you about what's gone well, generally.
So what's the one bit of advice or the one thing that you see not so many people do that's actually good for a financial tip? What's one thing that you would...
Something that's quite hard to do, but I advocate this all the time, no matter your age, doesn't matter about your age, is it's not necessarily focusing on the day-to-day. It is about making sure you are focused on the day-to-day, the work, making sure you're generating your wealth and you're earning your money. But if you're saving and investing, it's looking at why you're doing it. What's the purpose? What are you heading for? There has to be an end game.
Yeah.
And that's what you need to think about, is going, right, what do I want to do and what's it going to cost? Don't think about what can I afford to do, because most people come in with that mindset going, have I got enough? Because it's too late sometimes. What I try and encourage is to go, right, what do I want my life to look like at a certain point? It might not just be at retirement. It might be at age 30 or 40 or 50, and there might be certain things you're working towards. So you go, right, well, if that's the goal, what have I got now? And what's the gap? And then you can start to really focus on how you bridge that gap to get you to where you're going. And that is something which is really, really difficult to do, but is majorly important, because without a focus and a goal, the chances of you getting there are slim to none.
Do you know what's really funny? Because I actually put out an Instagram reel, I think 2 days ago, saying, look, with a business, you have to plan. You have to sort of go, right, okay, this is what we're doing in this year. Yeah. And then you break it down into each month and you have a little review over it. And then this is the 3-year and the 5-year. And what people don't realise is they'll do that with, oh, I'll go to the gym and this is going to be my plan for the week. Yeah. But they can't do it with their own finance. Yeah. And I don't know whether it's because people think, oh, I don't know about that. And this is why obviously having you on the show is to get people to think about, well, actually, Matt just told me that I could put £20 away, or I could put £50 into the kid's pension, and the kid could be a millionaire by the time they're 60, 65, just to jog people's mindset into doing these things. Because my thing is, and what I'm trying to get across to people is, I'm 41 now, probably when I get to retirement age, because they're talking about taking it to 70. Yeah. There won't even be such thing as a state pension. And there's not, and people are going to turn around and say, oh, I've paid in all my life. Why haven't I got a state pension? And I'm trying to say to people, look, if you don't think about it, no disrespect to the government, they're not going to be able to think about it. They've got an ageing population, and they're not going to be able to afford to pay for everybody. And
it's a really good point. Because going back a few years, the government actually came out when they moved state pension on from what was 65 to what is now 68 for anyone in our sort of generation. I'm 45 for anyone who wants to know. Yeah. I know I look out younger than Al.
It's the camera angle.
It's the cameras. Yeah. But the encouragement now is that you have to pay in. You've got to look after yourself, because the government aren't going to be able to afford to do it. National insurance contributions, that's what you pay. Until you stop work, that's what you pay, and that's what pays for state pension. But with an aged population now, and science that's better, medicine that's better, people are living longer. So when people used to retire, they used to get to 60, generally speaking, they'd have like 5 years, 10 years, people would die at the age of 70. Yeah. That isn't the case now. And the government are actively saying, unless you look after yourself, there's not going to be a great... And let's be frank, right?
We've got lower productivity as well, so we've got less working-aged people working, but an ageing population, so you've got those
that's using the state pension, and what is it now? 10.5 grand a year on a full state pension now. But if that was all you got, so you got to retirement, you didn't have a sellable business, you hadn't saved along the way...
Haven't paid your mortgage off.
How miserable is your retirement going to be when you can't physically work anymore, or you don't want to work and you have to, at the age of 70, let's say. But I know people like that.
But this is the funny thing, is I have so many people that have put out these reels who go, live for the here and now. You might not even be alive when you're 60. But what happens when you live to 100 and you've got that miserable existence and you've got no money to do anything? You've got 30 years of your life sat in a house or a home with no money to you.
And possibly a council house, or possibly somewhere you don't really want to be.
Yeah.
And it's just having that eye on going, I love my life now. Do I want my life to look the same or better when I don't have the capacity or when I don't have the desire to work anymore? And that's why it's really important. Don't work on the basis of what the government could give you, because we don't know it's going to be there by the time you get there. The state pension might be gone. Who knows?
This is not taught at all at schools, but it sounds like this should almost be mandatory.
Yeah, I would agree with that for sure. Schools don't teach money, they don't teach finance, they don't teach savings, they teach you how to remember stuff. That is pretty much what schools do. They teach you how to turn up every day, something which I didn't do. But they teach you how to turn up every day and follow the rules and do a good job. The money aspect, not even my parents taught me about money. They didn't have a clue, really. When I look at my dad, who managed a quarry, my mum, who was a secretary, that was their life. That's what they did. They didn't make any major wealth. My dad's had challenges with his pension as he got older. He took some bad advice, not from me, I hasten to add. But he lost a lot of money there. They didn't know how to manage money properly and lived hand to mouth, really, bringing up 3 kids. And I do think that schools should do more, for sure. Can I change that as an individual? No. Can the Andrew Tates of this world change it? No. I think there needs to be a serious shake-up with schools, for sure. But to try and take the bull by the horns for yourself, as a young apprentice perhaps, who's got the opportunity to maybe just, even if you don't have the money to be able to talk to a financial advisor like myself, and it's not because we're stuck up or snooty, we've just got a business to run, so it's for people who have...
Where would you say, because the one thing as well online is there's so many people giving advice. And
there's some terrible stuff, so this is a good warning, right? So there are a lot of Instagram warriors out there. Alex. There are some Instagram people out there who are not regulated advisors. Well, they're not chartered accountants.
The only thing I always said was any advice that I get or any knowledge that I get, it will always be tossed back out for free.
Yeah.
So that's the one thing that I always find really frustrating. There's a lot of people that have been quite successful. Some of them, I don't know how I wouldn't say legal, but how ethical it's been to get there. But I always feel like these people that have gained this information but then want to charge it back to you.
Yeah.
I'm always very wary of DM me to get started. That sort of stuff that you see on Instagram. So where would you say then for somebody young, because it doesn't get taught in schools. It didn't when I was at school. I'm sure obviously you guys as well, you've just mentioned it as well, Jack. Where could somebody go to educate themselves financially about certain things? As sad as it sounded, when I first sort of started looking at my finances, I was looking at that money saving expert, Martin Lewis, just to sort of...
And do you know what? That's not a bad place to start, because someone like Martin Lewis, who, I don't particularly like him, but actually what he delivers is simple, it's effective, and it's factual stuff. He has behavioural things you can do. It's about using your tax allowances wisely. He talks about that. He talks about, finding better savings accounts, paying attention to your money, trying to think about how you spend your money on a daily basis. Come back to what I said earlier about, I used a figure of 27 quid a day. It's easy just to blow that sort of money. If you can do the behavioural stuff first and get into good habits, then all of a sudden you'll be in a position to talk to a regulated financial advisor like me that can then start to help you map out things better. So I don't think you need to make it too complex from an early age. An early age bit is find some habits, look at your bills, do an expenditure. It is the easiest thing to do, is go, right, what are my bills on a monthly basis? We use a simple expenditure sheet. We send it out to clients, and it's just like gas, holiday, food, clothing, whatever. And you don't have to live to the penny of what you write down every month, but be aware of it and go, right, what have I got left? And then once you do all of that simple stuff, that's what will put you in a position to then talk to someone who is qualified to do what they do, to then push things on and start to then build on the wealth you've already...
Because I actually am very similar mindset to what you've just said, is know what you're spending, know where it's going. But you get some people on the flip side that go, well, all you're doing is telling yourself you've got no money left at the end of the month, so you can't go and do this. And then that stifles the entrepreneurial side and they say, well, what that should be telling you is you need to go and earn more money. Well,
yeah.
In a simple world, that's a very good sort of generalisation, but actually it's not always, achievable for somebody to go and do that. They're working in a full-time job and they don't have the time or some of the time to be going and doing that. But if you get into the good habits of doing that first, when you do have that opportunity to move up the ladder or start your own business, you've set that foundation. So
running a business isn't for everyone, is it? Not everyone has the mindset required to do that. So everyone's different. So if you are in an employed role, it's about being realistic with your own capacity to do stuff. It's also, I suppose, on the flip side of that, use the flip side tattoo for that one, if you remember. Yeah. On the flip side of that, I'll do it after I've done a training session.
On the gun show.
Wealth is relative to you. Wealth isn't just about money. It's about life. It's about happiness, your soul feeling good, all that sort of stuff. But it's, relative to everyone in different situations, it's about thinking about what's important to you, not about looking at what someone else has got and going, well, I want that, but then you haven't got the capacity to get there, or you don't want to take the risks. Because setting up a business is risky, it's hard work, it's a damn sight harder than being employed, in my view. I've been employed and I've employed myself, and I know what's harder. To grow a business is much, much harder. You moan about working hours when you're with an employer. Double that when you're working for yourself.
It's always like whenever anything goes wrong in your own business, it's always you that has to deal with it. Everybody else gets to go home and forget about it, whereas you're the last one to go to bed.
Are you wasting time? I think that some of you probably are, and I have a solution for you. Nobody wants to do any type of admin. Now, I have a solution for you, and it is called Tradify. It's a fully automated job scheduling, invoicing, and quoting all in one place. Now, that software is going to save you 12 hours a week, and all by using a simple software solution. Now, you can try it for 2 weeks, absolutely free, no cards needed, and you'll even get support in person from Tradify themselves. Now, when you're done, you can always come back to me and thank me, but just enjoy the extra 12 hours that you're going to gain from just using the software.
You've got to sort of, I think we were talking, because I've gone off piece a little bit now, so I've lost my train of thought. But
so
it's all right. Where was I going with this? Because we started on schools and we've gone through all of that, financial education, going into sort of apprenticeship aspect, or younger people perhaps, or employed. So I think where we're talking about maybe people who are employed who don't have a business and probably don't ever want a business, are quite happy to go to work and do that for someone. The same principles apply. It's just going, what's important to me. What does it cost me? What have I got left? What am I doing to think about tomorrow?
Well, even something, actually, I want to touch on this, is say if you were to get a bonus from work, you can put that into your pension, can't you?
And again, people just take bonuses and a lot of the time think, that's a holiday, that's a car, it's whatever.
But you
pay off some debt,
pay your tax on it.
Yeah, and you pay national insurance on it as well. So the power of sacrificing bonuses is that, sacrifice some or all of it into pension. It doesn't have to be all of it. With a good employer, they will also pay, because if an employer gives you a bonus and it doesn't go into your pay packet, the employer saves their national insurance contribution. And actually, what I encourage a lot with anyone who's employed that I look after is ask the employer for the NI back. And they'll top that up onto your pension as well. So not only are you not paying your income tax on it, you're also not paying your own national insurance. And then if as a bonus, if the employer will do it, they'll rebate their insurance back to your pension contribution as well. Major. Again, if you can just get into the habit of saying, well, I want some of my bonus to go and enjoy life. I've worked hard to get a bonus, therefore, I might have a holiday. But think about that balance again, going, well, how much should I put to that and how much should I put for tomorrow?
Everybody lives for the
now.
For the now.
Yeah. And I enjoy life. I enjoy some of the good stuff. I enjoy going on holidays. My wife definitely likes making me go on good holidays. I probably wouldn't go on holiday if it wasn't for my wife. I just focus on work. But you've got to find that balance for you as an individual. You've got to.
Anything else you think we should touch on?
It's not really something to touch on, but I was just curious, what would you have ended up doing if you weren't doing this?
That's a good question.
Superstar DJ.
It would be. Do you know what though? It would be. I would.
I can imagine you, Kevin and Perry. the smoke coming down and amnesia or whatever it is.
Exactly that.
Isn't it?
I love creation, and it's funny. I sat with a few producers, music producers.
Yeah.
They do a lot of content for like Chasing Status and some other like big name people. And I sat with them the one day and I was like, I wish I could be creative like you. That's what I said to him. And he turned around immediately without even thinking. He was just like, but you create wealth plans for people. So you
It's the
are a
same,
creator.
yeah, yeah.
You create stuff for people. Like how you created lighting for a need, you know, and we're all creators. Passionately, I love music. I love that industry. I don't think it'd be that easy to work in that industry because I see a lot of producers who are just hand to mouth continually creating. I think the music industry needs a bit of a shake-up as well. But from a passion perspective, if I wasn't doing what I'm doing now, I still love dealing with people. I would still make a business out of it. I think that's one thing I could take away from what I've done with this company and to grow it to the way I've built it after 14 years is I could apply the same mindset to anything. And a passion would be to do that in music for sure.
Yeah. And maybe you need to shake up the music business.
Yeah, maybe next challenge. Yeah, got to shake up the schools first, though, right?
DJ talent manager. I just want people to sort of, and the reason I started doing my thing, A, because I had a cheeky little bet with some of my mates that I could do it, but B, I want to sort of, people look at some of these and think, oh, how boring is talks about 2 bits of branding. But it's all these little snippets that if they ended up watching every single video that I ever do over the course of when I do this, they'll go, do you know what, actually I've learnt loads here. Like the guy's actually talking about loads of individual things and then it twigs somebody to go, oh, haven't thought about that. Yeah. Because like the amount, I don't know whether you read some of the comments in
I did.
Some of these and you just think, look, I'm trying to put a snippet of an hour conversation into 30 seconds.
Yeah.
But if I can just, you know, and somebody goes, oh, I didn't know that about, I could put 60k into my pension, 20k into my ISA, you know. So I don't know, what clickbait you got for us, Matt?
Clickbait.
This is not what you do.
I mean, some of the things we do as advisors, you know, we've got a whole different ream of products to help with building and growing wealth, right? So you've got things you've talked about, your ISAs, you've got obviously all the cash side of it, premium bonds, national savings, all of that side. Pension, majorly important. Everyone says, you know, it's a pain, you can't get at it. It's the biggest and best thing you will ever do, without question. But when you've got wealth and you've started to build that money and it sits either in a business or it sits in your personal account, you know, a lot of people don't understand some of the products you can use to reduce income tax.
Yeah.
In addition to your pension. Venture capital trusts, high risk investments, but still well diversified. Coming back to what I said earlier about making sure that things are well spread. Venture capital trusts, you get an allowance every year of 200 grand that you can pay into a venture capital trust or a series of different venture capital trusts. You've got a lot of different providers. Venture capital trusts in simple terms are just startup businesses. We're not talking sort of corner shops here. We're talking multi-million pound businesses, but they're startups. And ultimately those startups are then needing cash flow to come in to help them grow the business to a point of exit or to have it acquired, whatever it might be. But to support the economy, the government, HMRC, will allow you to have 30% income tax relief on that money. So if we use 100 grand of invested money into venture capital trusts, immediately, within 2 weeks of making that investment, on average, you'll get 30% income tax relief. So all of a sudden, you're only paying with 70p in the pound. Yeah. That's your risk money. There's a few things to this, so I'll cover it bit by bit. If you can get into the habit of doing 100 grand a year, perhaps, let's say you're doing well. You've got 100 grand a year you can put into venture capital trusts. Do that in year 1, 30 grand back. Year 2, do the same again. Put 100 grand in, you get another 30 grand back, and so on and so forth. Come year 6, venture capital trusts have done their 5-year term. That's the minimum holding period you need to have it in for to benefit from the tax relief. If you take it out early, which isn't easy to do, but if you did take it early, you would give up the tax relief. You'd have to pay it back. So 5 years is that term. So come year 6, year 1's money's matured.
Take it back out and put
it back out, assuming you can, and assuming you want to. You don't have to. But then you can recycle that same money back into a new venture capital trust and get another 30% tax relief on that same £100,000. Not only that, venture capital trusts also produce dividends or can produce dividends. Those dividends are completely tax-free.
Yeah.
I'll have to give an average because this isn't the same for all providers, but on average they try and target a 5% tax-free dividend. Now, you can either take that dividend out, just have it, spend it, or you can have it reinvested back in. The dividend that's paid back in gets another 30% relief.
Okay.
So by virtue of having them reinvested again, you keep doing that, you're getting further tax relief on there. They are high-risk investments for sure, but it's another tool you've got. So I'll give an example. There's a company that had to get £1 million out of his business. Sizable tax paid on that dividend that he's taken out. But he didn't need all of it at the same time. The reason we did it is he had lost his pension allowance. I know this might be a little bit complex, but he lost his pension allowance because of his level of earnings. Yeah. So when you get to a certain level, roughly around 360 grand, you've only got a 10k pension allowance. So what he did, or what we advised him to do, was take out double the amount of dividend he needed to take out in year one, which then covered him for year two. So now he's got his pension allowance back in year two. We had to keep alternating the years to do this. But he's got a massive tax bill by taking that money out. So then we use a massive proportion of it, or a good proportion of it, to go into VCTs. Yeah. So then instead of paying the 40% tax, he's now only paid 10. And all right, he's still in high risk investments and he's in a position where he can afford to sort of spread risk quite a lot. But these tools, you don't need 100 grand. You could do it with 10. Yeah. You do it with 20, whatever.
This is what I've been trying to get across to people, is people who are higher net worth get to there by reducing their tax bill or reducing their liability, basically. Yeah. It's not so much always, I've gone out and made so much money. It's how well can I manage that money to sort of not have an impact at the end.
And it is about exactly those habits. It's about how can I use the reliefs that are given to me, because they're there to be used.
Because most people watching this will think it's a tax dodge or something random, but it's not. It's just being clever with the money that you have.
Yeah. So if you think about it, something that, again, I was taught, so this again would help, I hope, most people's mindsets. So if you think in a bank account, if you've got savings in there and you're a basic rate taxpayer at least, so you're earning over 12.5 grand a year, you're going to get taxed on that savings income 20% or 40% or 45%, depending on your earnings. If you put it in an ISA, zero tax. Yeah. You put it in a pension, you're given 20%, 40%, 45%. So when you look at those three things, where would you put your money? Somewhere where you're taxed 20%, somewhere where you get no tax, but you've only got a limit. You can only pay 20 grand in. Yeah. Or would you pay it in a pension where you're given money? So your net cost becomes less. So it's about using those tools well. Again, coming back to like how you distribute dividends and, using other tax advantaged investments. All of these reliefs are there for your benefit, to use them to make sure that you're just not squandering money either out of your business or your income. Again, we're all using it for tomorrow, but this and we question whether we're going to get there, and we could die and all the rest. I mean,
this is another thing as well. Is a lot of people don't realise what's available to them. So this is why I always say, like, try and research as much as possible. If limited companies, and if that's what your business is, like, what can I take as a director, or what things can go through a business? Because some people don't put certain things through a business, not realising that actually you can put that through a business.
Having a good accountant is a good start. I don't know, everyone has an accountant, maybe they do their own self-assessments, but most people, I would imagine, have an accountant to either do self-assessment or their company accounts. And it's just ask the question, number one. Don't just be complacent and go, they provide the accounts. Ask the question, go, what else can I do to reduce the tax I'm paying here? Most accountants will know the tools that are available and the things I've talked about today. And even though they're not qualified to give advice, they can still go talk to a financial advisor or set up your pension perhaps, or do this. They can say to do they can give some guidance on simple things to do. Yeah. But don't just accept things, question it. Ask, what else can I do here to not pay this amount of tax? Yeah. How can I make better use of my money? And it could be simple things, going, well, you're spending this on that crap throughout the year. Yeah. Maybe stop doing that, or maybe think about reducing whatever you're blowing money on.
Because most people go out at the end of the year and buy a load of stuff, so they have to pay less tax rather than actually
And do
putting.
you know what? I hate seeing that. It's so counterintuitive. I mean,
It's big in the public sector.
It's madness.
Is they've got a budget, and if they don't spend it, then the budget gets reduced the next year.
even at that level, I think, yeah, don't get me wrong, there are levels. Yeah, so if we're talking major PLCs, it may be a bit different. And if you've got, if you know that you can shift some money into another tax year by spending what you would have spent
The
in the
electric
next tax year,
vehicle car.
that's, do we talk about that again? Porsche
I don't know,
Taycan.
the petrol heads go mental. EVs, who wants one of them? Depreciating, bags it.
Well, I'll tell you what, yeah, we did it. Just put a Tesla through the business and 100% write-off. No brainer.
Yeah.
For one car at least.
Yeah.
Would I put another non-electric vehicle through my business? 100% no. Not for the type of vehicle I want to drive anyway. It cost a fortune. But moving money and spending to reduce your corporation tax is fine if you've got a need to buy something that you actually need.
Yeah.
So if you can bring that into this tax year rather than next, why not? That's fine.
Yeah.
But spending it just to get your tax down for no reason is really short-sighted and screws a lot of people up.
So round about this time, Matt, we tend to do like a final thought, which is basically you can either drop some knowledge, wax lyrical, or you can give some advice to maybe younger people or to anybody in general, or you can sort of shamelessly plug your wealth planning services. But most people tend to sort of give a bit of advice at this point, where you'd sort of say, well, actually, look, if you're this age, I'd be looking at this. If you were here, then do this. But it's entirely up to you. This is your Jerry Springer.
You've talked about I can be shameless and promote the company.
Wealth plan.
Or, by the way, you could be really good and just give some good advice to it. No, so 100% I'll do that way.
Didn't Roy Davis shamelessly plug him? Didn't he?
No, it's Adam Dunlop.
Adam Dunlop, he was like, blah, blah, blah.
No, I don't need to do that, thankfully. But so, I'd like to think that some people can take bits away. To summarise, from a young age to say, I don't know, 25, so apprentice level perhaps, it's just build those good habits. Understand what you're spending, understand what your bills are, and whatever the surplus income is, just put a little bit away. It doesn't matter how much it is. It could be 10 quid, 20 quid, 100 quid, whatever's affordable to you. Do something rather than nothing, with a hope that you might live tomorrow. Do that. Be in those good habits. Then all of a sudden, when you're wanting to talk about things that are a bit more interesting, or you've got some money, you want to know how to grow that more, by having those decent habits today, you'll be in a much better position to be able to go and talk to someone like me or an accountant to go and say, well, what do we do next? What's the next step? How do I get to my next goal? I think for everybody, set goals. If you don't have a goal, you're living day to day, you don't know what's going to happen. By the time you know it, you're 50, you're coming to me going, I'm worried. I'm retiring in 10 years. I don't think I've done enough, or I definitely haven't done enough. Having 10 years before you're going to retire.
People don't realise, I don't think, that your actual working window, even though people go, oh, well, I'm going to be working till I'm 70, your actual working window where you earn a decent amount. I'm not just talking earning, like when I was working at Morrison's or pot washing or whatever I was doing, like an actual decent wage. And then what you don't realise is actually when you do start earning that decent wage, you've normally got a house, you've got more outgoings as well. So it's trying to educate people that actually you've only got a short space in which to earn your retirement. Yeah,
and it is short. And let's be frank, most people, majority, are going to live longer than you think. So it's about manage your debt well. It's about, this might be controversial a little bit, but I pushed myself massively on my first mortgage. I was like, right, max out as much as I can do. The reason for that wasn't just because I wanted to show someone I had an amazing house, or I had this amazingly valued house, whatever it might have been, whichever way you want to look at it. It was about going, if I do that, I've committed myself to paying that.
I was very similar.
Yeah? Because all of a sudden now, my mindset's going, well, I need to firstly not lose my house. And secondly, I want to be paying down that debt as quick as possible. And thirdly, if I do that and I push myself harder, then I'm going to be able to generate more income to do other stuff. And it's about, if you can push yourself to a limit, a comfortable limit for sure, and it's relative to everyone's individual situation, but if you've got to carry that,
if you make more sacrifice in the earlier day, then actually later it's because I was very similar. Was I pushed myself with the deposit for my first house? I actually was like, right, I need that deposit.
Yeah.
Because I made more when I came to sell the house.
Yeah.
Whereas I could have gone and bought a cheaper place. The first one that I did, but I was like, I need to aim there.
Pushing yourself.
And I lived on baked beans on toast. I actually became a connoisseur of different types of baked.
What was your favourite?
I'll be honest. The co-op baked beans were
Really?
probably
No way.
And this was like I used to. It was really sad. I was like league table on baked beans
I
for a good.
love a Branston bean. I don't know what it is. I like Heinz.
Thick
Branston,
sauce.
Yeah, it is thick, isn't it? It's
Thick sauce.
Baked beans.
But co-op back in the day, not so much now. But back in the day, the co-op baked bean was a good one. How sad am I? I was like a connoisseur of baked beans. But that's I had the same mindset. Really, was actually if I push myself here, and then on the next every house actually where I've moved, I've stretched myself.
Yeah.
Not to a point where actually I couldn't live, but stretched myself to be like, well, actually, if I make this jump. But the other thing that I did, which was quite clever, was just kept moving.
Yeah.
Because then your house tends to go up, but you have to buy in the right area and stuff like that.
Of course. Yeah, you've got to use your head with that. But, I think sacrifice is key, to some degree. Not so you've got a miserable life now.
Yeah.
But sacrifice is definitely key. I'm very grateful and fortunate for where I am today.
Well, you can work, though, now. But when you get older, you don't want to.
Your desire to work will reduce for sure. And then you become, it just becomes either a labour of love or it becomes pretty miserable turning up every day because you haven't done enough to allow you to stop when you want to stop. Comes back to the goals again, going, well, when do I want to stop realistically? How long do I want to do this for? What else do I want to do with my life? That you've said about a short working life, it's a shorter leisure life.
Yeah.
If you retire at age 70, I cash flow model things for people to show how long their money will last in their lifetime. And at the age of 80, I'm reducing their cash flow, going, well, you're not going to be doing that holiday. You're not going to be travelling around the world. You're not going to be doing this, that and the other because you haven't got the health to do it. You haven't got the desire to do it. So actually you're spending a capacity or spending years that are available to you when you retire. Most people would want to retire early. But if that's the case, you need to do some stuff now to enable you to do that.
Yeah.